Welcome to the Uncontested Investing Show, presented by REI Inc. magazine and sponsored by RCN Capital. Each week, we focus on bringing you candid convos from the best in the biz. Here's your host, Tim Harridge.
Welcome back to the Uncontested Investing Show. I'm your host, Tim Harridge. Today, I'm here with my good friend, Suzanne Andresen. Suzanne, thanks for stopping by.
Thanks for having me, Tim.
Well, I'm glad you're here. And in the interest of time, why don't you just go ahead and just tell everybody a little bit about yourself.
So I've been in real estate for many, many years, selling it out of my dorm room at the University of South Carolina in 1986 as a hall advisor. And for whatever reason, kept going forward with that and worked at several publications in the space, but certainly am happy to be part of the ownership at REI Inc. magazine. We really love the publication we have. It's been around for over 3 years, and it's a well-respected messaging platform for the real estate investor space. We've also developed our referral network, REI Referral Network, which is an opportunity for the investors to connect with real estate professionals to help source acquisition and disposition strategies for their portfolio solutions. And from there, we recently launched our Highest and Best acquisition platform, which is a way for investors to connect with assets that are off market. It's designed to premiere the assets on Tuesdays and go on contract by noon on Friday Eastern. And truthfully, it goes to the highest and best offer that's been submitted. It's been very successful, and I think it's a great way for investors to source some of the assets that are really difficult to find these days. And we found a way to make it successful for them.
Very nice, very nice. So I'm a big fan of REI Inc. and the publication. I think you and Bob are just doing an amazing job. Having been a real estate investor for more than 20 years, I get a lot of things in the mail, but your magazine is one of those things I enjoy getting in the mail and actually looking at and reading, and I find a lot of value in it. So kudos to you folks. So every week, what I like to do is start with what I call the bottom line up front, the bluff. So when I was in the Marine Corps, as an intelligence guy, I would brief generals. And the first thing you have to learn is you never bury the lead, because you could get mortar fire, or the general could have something more important to do, and he may have to get up and leave, and you need him to know the most important thing that you had to tell. So Suzanne, what we're going to do here is you're going to take up to 2 minutes, and I just tell everybody, try to cover the most important trends that you see in real estate today, things that you see that maybe investors should be doing, or if there's anything you see or you're hearing that investors shouldn't be doing. Does it make sense?
Sure.
All right, here we go. Bottom line up front, go.
I would say that my best advice to give investors these days is, as they're finding it very difficult for them to source their assets for their portfolios, that they make sure they do the appropriate due diligence for that. There's so many things with assets coming out of forbearance and foreclosure properties that they can miss overlooking. So some of the things that we do in our newsletter every Monday and Thursday are lead stories and assets somewhere in the country, and we share how it's performing on the local MLS, both from a listing and sold perspective, so you get a good local market metrics for the information, but we also then show what the rental rates are. And this helps give some of the buy and hold investors the opportunity to evaluate what they're using for their rental analysis and what they're charging for it. And a lot of times it gives them an idea that they're probably undercharging. You can't necessarily automatically, go up $200 a month, but you can start preparing to increase your rent for your tenants and get them to what the market rates are. But with that, we also share some of the foreclosure and REO asset analysis through that area. And perhaps you like the market, but not the asset that we're sharing. We're teaching you to source an asset, go to an asset management company. We've got connections for that. And it gives you the ability to really buy your assets properly. It's okay if there's a municipal lien against it. You just want to know that up front. Knowing that there's 2 years of real estate taxes, that's not a big deal. You just put that into your evaluation and how you're going to make your bid. And that's part of going about it with the correct due diligence. We're in a market where valuation is off the map right now. That has to stabilize over time. We can't maintain a 20% overvalued asset. In the 2014 market, when we saw the real estate mortgage analysis and all of these issues coming out of there, that was really stable, sent from bad lending practices. And the term that came out of that was underwater. All these assets were underwater. Well, I think that we're facing into a new term in this market, and I'm guessing it's going to happen between the March and May timeframe of next year, and we're going to transition the underwater market to under equity, which is terribly unfortunate for all of the investors because, or for all the homeowners in today's market, because they've purchased these assets at a higher percentage rate, and they're not going to be able to afford that when they sell. But what it leads to for the investor market is a need for more rental properties, and that's really how we need to make sure we go about our due diligence.
Man, that was good. So under equity, what do you mean under equity? Like they have too much equity? What do you mean under equity?
So the underwater was when houses you owed more than it was worth. So now these homeowners that have purchased at a premium are when as they go to sell, and they're not going to, maybe not selling the next 2 or 3 years, but within 4 years, if they feel that they have to move or relocate for whatever reason or transition to a different home, they're at risk of being now under equity. They will have lost perhaps their 20% down payment because they bought when the valuation was higher than it should have been, and it became almost a feeding frenzy for that. But now if they have to transition out of that home for whatever reason, they're going to be under equity.
Under equity, new word for me. So that's, for them to be under equity in your example, that's calling for a correction.
Well, it's yes, there'll be a correction. I think there is going to be a valuation correction. 100%, I believe that, and I think it's going to happen sooner than later. Everyone's like, "Oh no, it's far enough away." I don't think. I think it's I'm going to say by next May, we'll see a substantial correction.
Substantial. Mm-hmm. You keep using these words, I'm going to box you in a corner.
Do it.
All right, substantial. What do you mean? 20%, 50%, 100%?
More than 10.
More than 10. Okay.
and that's going to play into. So if you put a 20% down payment as a homeowner and you bought your house. And it takes us a long time for someone to save up a cash down payment. So if you turn around and lose that because you need to transition somewhere else for whatever reason, you're now at risk of losing that hard-earned money as your down payment. That's your under equity.
Do you think that is? Get this right? Are you saying a 10% reduction across the board? Or are you thinking some of these like San Diego,
certain markets are going to be higher than 10, and certain markets are going to be lower. I'm going to say it's an average reduction of 10%.
Wow.
We've, and I live in Maine, and we've seen a huge influx of people coming into Maine and buying well over 10 and 20% in value, and it has to correct. It can't stabilize. It can't maintain this value.
But do you think labor and materials will? So one of the problems I see with the quote unquote valuation math is we've had what I believe to be a permanent increase in replacement cost. The only way wages and prices go back down would be stagflation or a wage price spiral. And I just don't think our politicians are disciplined enough to allow that.
I'm not going to go down a political path.
I mean, all of them.
Yeah, but I think that.
Hear me out. Hang on. It's not politics. It's actually American society. To me, we've become really impatient and not loyal at all. So if someone's unhappy about gas prices and 2 years ago they voted one way, they'll just change the way they voted because they want to save some money at the gas tank. And we're in this instant gratification society, and I just don't know if we have I think we should force a 10% reduction.
Well, I think, but your instant gratification mentality, I absolutely agree with, and that's what fed to this frenzy to buy, which then buoyed the valuation.
Right.
And I think that's beyond where the actual house is worth. And the banks aren't going to be at risk. Any funding behind that is not at risk. The people who are at risk are who bought the house at that price.
Right.
And if I want to say selfishly for the investor space, those people, a place to live is I think your most near and dear component to your lifestyle. So whether they're a homeowner that has to transition, they're going to now have to rent, which then feeds again selfishly into the investor market, where the buy and hold and rent folks are going to do quite well with that.
Well, I love that I disagree with you, because that is going to give us
not the first time.
That is going to give us a lot to talk about after the break. We'll be right back.
Are you looking for fast funding for your next fix and flip? What about leverage for your next long-term rental or vacation rental? Need capital for a new construction project? Look no further. RCN Capital has you covered. As the leading nationwide lender for real estate investors, RCN Capital offers short-term and long-term financing solutions for your next investment property. RCN Capital takes a common-sense approach to your loan request, offering high leverages and low rates backed by superior customer service. Whether you're investing in single-family properties or multifamily properties across the U.S., RCN Capital has funding options for you with no hoops to jump through and quick closings in as little as 2 weeks. Ready to get a quote for your next investment property? Visit rcncapital.com/podcast to apply today. There is no fee to apply. Again, that's rcncapital.com/podcast to apply today.
Welcome back to Uncontested Investing. I'm your host, Tim Harridge. I'm here with my friend Suzanne Andresen, and we are going to argue. All right.
Bring it, Tim.
So, does Amazon call in the 20,000 people they hired last year and say, April Fools, it's not $18 an hour anymore, now it's $12 again?
I don't think you're going to be able to have that quick an impact on wages. We've seen through the past 2 years and coming out of a pandemic, 85% of the population has been able to prove their ability to still be very effective working from home. And that's where I think a lot of these folks have transitioned in where they're choosing to live. And I think that, there's pros and cons. I've been working from home since 2003. And I think I love it. It works really well for me. At the end of the day, I'm able to get all of my lifestyle needs in place, which includes work and family. And I think, what you at risk for that is the office camaraderie. What you gain is a lifestyle choice. And I think that's going to provide the desire for people to be able to move more frequently to where they want to go. And if they can't afford it, they're going to have to rent.
So I think that's why Maine won't have a correction, because people now you make things, you make articles, you make business plans, but you don't print that newspaper in Maine or newspaper magazine. You don't print the magazine in Maine. And the problem is, I completely agree. Like now people, they can make whatever they want and work wherever they want if they have a skill or a business. But the biggest thing driving the inflation under the underlying inflation is the delivery people that have to get you your stuff in Maine. The people that make the vehicles, you actually have to. You can't make a Ford truck from home, right? You got to go to the factory. You can't. I guess they can probably print that now automatically, but someone's got to put it on a truck, right? Someone's got to drive the truck, and then so it's when I look at where the wage growth has been, right? It's been a lot in the service sector because we had to pay people to come back to work.
Well, you're looking at, so the wage growth is playing into part of what's going on right now economically in the country. We are forced to provide a higher income for folks to get them to pay for the higher gas that they're paying right now. And some of those folks may or may not choose to move forward in that transaction. It's either going to work for them or not work for them. So then maybe working from home becomes a more suitable solution for them at a lower rate, but they still get the lifestyle choice that they want.
It's going to be interesting the way it plays out, because as I look at history, right, not just where we're at, but where we've been before. And when in 1982, or in the early 80s, when everybody said the last time we're beating those inflation records, values kept going up for 10 years. And that's with 18% interest rates. And when I look at it, to me, and I said this last year from the stage, and I'm going to stick by this, and then a year from now, we're going to have to redo another one of these.
Bring it. I think I'm staying on track.
Replacement cost is the new low comp. And most of these houses, you still can't build them for less than people are buying them for. And that's going to keep values up.
Yeah, maybe. I agree with replacement costs, but if you've got someone, let's say someone moved to Maine. We've had quite a few people who moved into Maine, and they fell in love with the Shangri-La that they thought they had. And now they're facing their second winter. We had a very light winter last year, and all of Northeast had a light winter. So anyone who came maybe from California to New England have experienced a mild winter, but now let's say we have a substantial winter this year, and they didn't realize they needed a snowplow guy or a generator or things to keep their house functioning the way they want it. They're like, oh my gosh, I can't do this again. They list their house. Those are the folks that are under equity.
Right.
And so it's not necessarily then the value, but a lifestyle choice.
Right.
And you've got to decide what way you want to play it. And working from home, some of the things that we're losing in that engagement is the office camaraderie.
Right. And
when we, my partner Bob and I, when we developed the magazine, everyone goes, oh, print's not here to stay. Well, our name, REI Inc., I-N-K, as in the written word, we believe that print's here to stay. And I actually think this home office, when we've lost that in-person touch, print media is actually on the rise. We've seen the open rates in our newsletter go up substantially. We sent out to 95,000 investors receive our newsletter. Our open rate's 22%. That's unheard of in a trade publication, in any publication, but even with trade, and a click-through rate of 13%. Those are substantial numbers, and we're getting feedback about the publication in the magazine that people are really enjoying it, they're learning from it, and I think that you're watching a whole transition from working from home, and that's going to play into the cost of this, the cost of living, where people will accept a lower rate to maintain a job. And if they're working from home, the gas price doesn't necessarily immediately affect them because they're not driving to and from work every day. So there's certain elements that we're facing right now financially that can actually be leveled off a little. But I do think that the pricing, when people move, we're in this frenzied move in the past 2 years, and they may or may not have made the right decision for them and for the family, they're going to then find that they have to choose another location to do that from, and that's where I think we're going to start to see the under equity.
Well, if I lived in Maine and it was winter, I would move.
I love winter in Maine.
And we had a kind of mild summer here in Texas the last 2 years, and people are starting to learn what it's really like, because I think it was 105 degrees of several days last week, and so it didn't bother me though. I was in California, so we're going to move on, and we'll check back in 12 months and see if we had the summer disaster of 2023. Let's talk about your referral network. Mainly because one of the things I like to harp on in this show is the value of one's network. And I subscribe to your publication. I pay to be a member of the referral network, the not the one that, I don't remember. I gave my credit card for something.
I've been using it ever since then, Tim.
So talk about what the referral network is, please.
So 2 years ago, we developed the referral network. So I'll take one step back. We saw the opportunity to connect real estate investors with the real estate professionals became a paramount need. And through that, we developed the opportunity to help source acquisition and dispositions in local markets. And many times investors, even more so now, have to step outside their comfort zone on where they're currently buying and develop a new location. So in order to do that, you need to be able to find someone in that potential new market that you're considering. So we have a network of real estate agents and brokers across the country that are fully versed in the investment space, and they come in by state and by county. We give them a limitation to what they can achieve from a population perspective. And it's designed to make sure you're the expert about that local market. Don't put some place down that you really aren't that fluent in, because it'll come out pretty quickly that you're unable to service what the investor needs.
So what's the difference between a real estate investor and a real estate professional?
Professionals are agents and brokers.
Service providers.
Service providers.
Okay. I was going to say.
Not nearly every real estate professional is an agent or a realtor through NAR, but not everyone is. So I try and maintain it as a real estate professional. And it's also through that portal that you upload an asset that we then pull down, and it becomes our lead story in the Monday, Thursday newsletter. It's also a way, if an investor wants to dispose of an asset, they can actually come in through that and list the asset for sale. And that's really the term from real estate professional. You don't have to be licensed to be in the network, but nearly every person is.
So if I have a house I want to sell, I can just throw it on the website?
You upload it through the portal, we get notified. We then do all of the due diligence. We'll back up to what I talked about earlier on the importance of maintaining your due diligence.
Who's we? Like, you're running comps in your house in Maine, or?
The company does it.
Okay.
We actually pull due diligence on the asset that we select for the distribution in the newsletter.
Yeah, I get it all the time. I get an email, acquisition opportunity. So you've already vetted that out.
Well, we're showing,
the
yes. So we're showing, there's two things. There's two different things here. We've got the REI Referral Network, which is a network to connect real estate professionals with investors,
right?
Whether it's acquisition or disposition. So you may have, and we encourage the real estate agents to connect with the investors, most importantly on the fix and flip. If you find them the asset that meets their acquisition strategy on a buy, and then they refurbish it and you've done right by them, you're going to get that asset back again to sell on the open MLS. So you get to double dip with the relationship. That's why it's so important for them to build that strategy with the investors.
So if you're an agent and you're listening to this, you need to rewind 60 seconds, play it again, then stop, rewind 60 seconds and play it again. Because a lot of people don't know what it's like to be in a position in real estate where you actually have to hustle for business. There's a lot of people that have only been in this a couple years when the rocket ship is going, far up to the left, and they don't know about that, the business development side of real estate sales. So that's a good one.
I think if you could teach a real estate agent to view it, it's really the life cycle of the asset. You've got 123 Main Street, and the Jones family owned it. And for whatever reason, a lifestyle change for the Jones family, they had to sell the house, or it goes into foreclosure. So that asset now is at a Y in the road. Is it a buy and hold, or is it a fix and flip? And that's really where, if you look at it from the performance and the lifestyle of the asset, if that asset's then refurbished and put back on the MLS, that's the fix and flip side. Or is it purchased by a buy and hold and rent investor? And you may still source a tenant for that as a renter, but it's really the life cycle of the asset. Or does 123 Main Street go back out on the MLS? Is now the Smith family now owns it, and they live there happily ever after.
And it's so funny, all the market adjustments that, even with interest rates happening the way they are, we're so massively undersupplied in inventory in this country. It's another part of my theory on why we don't go down, but we'll have a slowdown for sure. And I was talking with this young investor at a mastermind last weekend, and I was talking about, if it doesn't sell in 21 days, that's the trigger to take a look at your pricing, product, and presentation, the 3 Ps. And he goes, well, what's that? I realized he's never had a house on the market longer than 21 days. Like, I remember, not to date myself, but you can see the gray hair.
There's nothing wrong with that.
I remember when the average days on the market on FHA properties in Dallas was 90. And so you would put the house on the market, wait 21 days. That way you survive 3 weekends, and then you look at the pricing, product, and presentation, and change one of the 3, then wait another 21 days, and then look at the Ps, and then change. And how many showings, how many offers, any counter offers, any feedback. There's a lot of people that have not ever even contemplated that discipline in this industry that may need to learn it. So
let's talk about that.
Well, hang on. We will when we come back from a short break.
Okay.
We'll be right back.
REI Inc. is a monthly business publication for real estate investors, covering all types of real estate investments and strategies. It is the most comprehensive real estate investment publication on the market. All of the articles are written by the top leaders in the industry, so investors are assured of always getting the best information possible. Each month, REI Inc. also profiles the top companies in the industry and provides insights and data into key regional markets. Along with their sister platforms, the REI Referral Network and Highest Invest, real estate investors have exclusive access to off-market investment opportunities and national acquisition and disposition initiatives. To learn more, visit www.rei-inc.com, where you can also access the REI Referral Network. Also, be sure and visit www.highest-and-best.com to view the latest exclusive off-market assets with near immediate acceptance decisions and closing strategies. You can also email marketing@rei-referralnetwork.com to request more information.
Welcome back to the Uncontested Investing Show. I'm still here with Suzanne. Suzanne, we're going to get to the rest of what you have to say, but first, it's time for the Money Minute. Each week, I ask my guest to imagine there's an investor on the other end of this program that will only get 60 seconds of advice all month long. This is the only 60 seconds of advice, mentorship, guidance they're going to get. So I want you to just think about it. We got to do the money minute. You have 60 seconds. You ready?
I'm ready.
All right, go.
The biggest advice I could give any investors these days is to stay focused on your acquisition strategies. Make sure that you're doing the due diligence, connecting with your data providers if you have them, to make sure that you're seeing how the asset's changing in value over time. Use it to help set the standard and the base for your rental. I see most often than not, and we're predominantly with the mom and pop investors that have less than 25 assets across the country, they don't have the correct rental rate that they should be charging, but you can't automatically jump $400 a month to get you there. So if you can make sure that you study the data, partner with your local real estate agents, make sure that you understand how many days on the market is that vacancy at $1,200 if I took it down to 11 or went to $1,400. Really understand what that's going to do, but you also have to make sure that you purchase and buy the acquisition that it fits within your buy box. Don't jump off a cliff unprepared. It's going to get you into trouble, and pay attention to what's happening in the valuation right now. Valuation is going to change. I believe it's on a shorter term than most, but I think that we're going to see it self-correct. So just the best thing I could teach you today is to walk away with due diligence as a plan.
That was good. Due diligence is one of those things. We were talking about it this weekend in a mastermind. It's really easy to make money when you can just wait 3 months and the house is worth 10% more. It's really hard to make money when we'll just meet in the middle. We'll say they're flat, right?
Okay.
Let's just say prices aren't going up for values and wages and rehab costs. Everything's the same. It still takes more discipline than it took when it was going like that. So now we are into what I like to call rapid fire. Please keep your answers short and concise.
I'll do my best.
Bubble or not?
No, I don't believe it's a bubble.
Rent bubble or?
I think that more of a rent bubble, yes. I think that the rental rates are probably gonna go up more so than the rest of the valuation percentage-wise. Interest
rates, where do you think the 30-year homeowner interest rate ends up peaking?
At the rate, 8%.
8%? You think we get the 30-year purchase money at 8%?
I think it'll hit that.
Okay. Oh. You think
we're at 5 and change now?
6.
6? Like I said, we're two points away.
All right, so under equity, do you think we're going to see supply and demand? Interest rates go to 8%. People find out they're under equity. Don't they just stop selling their houses?
It depends. It depends upon the reason why you were considering that in the first place. Do you have a new job? Do you need to move closer to your parents? What's the driving factor behind that? Do you not like living in the Northeast because the winters are too hard? That you've got to decide what's right for your family and your situation.
So what I'm trying to figure out, and when I look back to the 80s, which is the only comparable time in history where inflation and interest rates were both through the roof and into the clouds, volume dropped significantly. And I believe that's what kept prices up. Knowing all the investors that REI Inc. knows, if there's even less inventory than there is now, where do you find a deal?
So that's one of the reasons why we developed the Highest and Best platform. We have relationships with many asset management companies across the country, as well as investors. We've got people that have purchased assets that are looking to have us help them sell. And so what we've done is develop the Highest and Best platform that brings an asset at a minimum rate. If you see that and you like it, you can put an offer in. It will sell at that rate or more, whatever the highest and best piece is. And it's a way for investors, whether you're a mom and pop or you're a REIT. Everyone's going to be buying at the same rate. And for those that look at it and evaluate it and respond quickly, it's a 3.5-day time frame where you're prepared to move forward. We can actually help you get that asset.
Are you hearing from asset managers that they are expecting more inventory or less inventory from the default side?
Right now, it's a very limited inventory, and I think they're waiting to see financially where we head. I think that's a tough prediction to state. I think we're going to start to see them trickle in. I think we're going to actually see more foreclosure and REO hit the market when we look at what's happening right now. Higher gas prices, people out of work and or not able to maintain what their living conditions are right now.
All right, so we're almost out of time. Any parting thoughts or parting shots?
Parting shots.
I give everyone a chance.
Tim, I wouldn't take a shot at you. I just think that, I believe that we've developed some strategies that I think level the playing field for some of the smaller investors. That's the predominant force behind this industry. It's 93% or more of the mom and pops. And I think, teaching them to do their due diligence gives them a little bit rounder perspective on how to stabilize their portfolio and make the right decisions. And we're here to help them get there.
All right. Well, Suzanne, if someone's listening or watching today, how do they connect with you? Certainly reach out to me. My email address, Suzanne, SUZANNE, at REI-INK.com. My cell phone, happy to share that as well. Oh, I wouldn't do that.
No?
Well, go ahead if you
No,
want.
it's okay.
Shoot.
No, it's all good.
I was about to say, this we hope to have really broad distribution on this show.
That's right. You're going to have to try and find me in Maine, though.
REI-Inc.com. They can get all the information on Highest and Best, the Highest and Best platform, the preferred vendor platform, the referral network platform. Subscribe to the magazine and make good friends.
Absolutely. Just connect with us. We've got a great product, a great knowledge base that we'd like to share, and certainly good partners like we have with you at RCN Capital.
Well, I don't like to give fake compliments, so I won't. No, I'm just kidding. Your publication's fantastic. I enjoy it.
Super proud of it. It really is. It's
I've
a nice
enjoyed having the relationship I have with you and Bob for many, many years across many, many different companies, and I look forward to continuing to do business with you. So thanks for being here. We're out of time.
Thanks for having us.
Thank you for joining us again this week on Uncontested Investing. Remember, your network is your net worth, and today you've been growing both. We'll see you next week.
Thank you for listening to the Uncontested Investing Show. Questions about today's episode or the podcast? Email podcast@rcncapital.com and make sure to follow RCN Capital on Instagram, LinkedIn, and Facebook. See you all next time. The preceding program is furnished by RCN Capital LLC. The information provided is for general education purposes only and does not constitute any legal, financial, investment, or other professional advice. The views, thoughts, and opinions expressed of any speaker are the speaker's own opinion and do not represent the views, thoughts, and opinions of RCN Capital LLC. No information contained in this episode should be construed as financial, investment, or legal advice from RCN or any individual, author, host, or guest. You should always consult a financial advisor before investing.